Welcome to the deep dive. Today we're zeroing in on a really core tool in technical analysis, moving averages, MAs, right?
That's right.
And our mission really is to explore how specific ones, the 9, 20, 50, and 200 period moving averages, can act as dynamic support and resistance.
Yeah, dynamic is the key word there.
Exactly. Forget those static lines people draw. We're talking about levels that actually move, that adapt as price changes.
Mm-hmm. And what's so useful about them is that constant recalculation. Every new price point adjusts the average, so it gives you a sort of fluid view on where buyers might step in, to stop a fall.
Or where sellers might push back.
Or where sellers might push back and cap a rally, exactly.
Okay, let's nail this down. When we say a moving average is acting as support, what does that actually mean? What are we seeing?
Okay, so if the price is generally trading above a particular moving average, that MA line can sometimes act like a floor. It potentially halts declines. That's support. The thinking behind it is, as the price dips back towards that average, which, remember, reflects a sort of recent price consensus, buyers might see it as a value area.
Like a bargain level based on recent action.
Kind of, yeah.
Yeah.
They step in, start buying, and ideally, that buying pressure stops the price from dropping further.
Got it. So it's a collective action thing, almost psychological, creating that floor. Okay, so what about the flip side? Resistance. How does an MA become a ceiling?
So conversely, if the price is trading below a moving average, that MA can act like a ceiling. That's resistance. It can hinder upward moves.
Right.
When the price rallies up towards that MA from below, sellers often get more active. They might see it as a good spot to sell, maybe take profits, or even initiate short positions.
Because they expect the price to struggle then.
Exactly. They anticipate the price won't easily break above that average level.
Okay, makes sense. But these MAs, they're not all the same, are they? The periods are different. Let's break them down. The 9-period MA, what's its personality?
The 9-period. Yeah, that's the sprinter. Its key characteristic is just how sensitive it is to the very latest price changes. Super responsive.
So who uses that most?
It's really popular with very short-term traders. Your day traders, scalpers,
Yeah.
people trying to catch really quick, immediate shifts in direction.
But that speed must have a downside, right? If it reacts to everything.
It does. That high sensitivity means it can also pick up a lot of noise.
Yeah.
False signals, basically. You might see it suggest a move, but then the price quickly snaps back.
Whipsaws.
Yeah, whipsaws, exactly. It can shake you out of trades if you're not careful, especially in choppy markets.
Okay. So stepping up, we get the 20-period MA, a bit calmer.
A bit calmer, yeah. The 20-period strikes, I think, better balance. It's smoother than the 9, but still pretty responsive to short-term momentum.
So useful for maybe swing trading, intraday trends.
Definitely. Very common for swing trading, holding for days or weeks, and yeah, analyzing trends within the day, too. It filters out some of that very, very short-term jaggedness you get with the 9.
Okay, a bit more versatile for slightly longer, short-term views. Now, the 50-period MA, this feels like we're moving into more significant territory.
We are. The 50 period is noticeably smoother. It gives you a clearer picture of the medium-term trend. Really widely used for swing trading still, but also for intermediate-term analysis.
And I've heard this one is watched by the big players.
That's a key point. A lot of institutional traders' funds, banks, keep a close eye on the 50-period MA. Their potential buying or selling around that level can actually add to its significance. It becomes a bit self-fulfilling sometimes.
Interesting how that works. Okay, finally, the big one. The 200-period MA, often called the trend indicator.
Absolutely. The 200 MA is really the benchmark for the long-term trend. It's very smooth, reflecting price over a really significant period.
So this is for position traders, investors.
Exactly. Position traders, long-term investors, they lean on the 200 MA heavily to gauge the market's overall underlying direction. Price consistently above it, generally seen as a long-term bull market.
And below.
Price consistently below it often signals a long-term bear market. It's like that major dividing line, the market's long-term memory, you could say.
Okay, great overview of the players. Now, let's get practical, using them for support. What's the first thing we need to see? The setup.
The basic condition, the setup, is that the price needs to be trading above the moving average you're watching. That's when it has the potential to act as that floor during pullbacks.
Pullbacks, like temporary dips in an uptrend.
Exactly. Retracements, pullbacks, whatever you want to call them.
And the logic, again, for why it might bounce there.
It's about that perceived value idea in an uptrend. The MA is rising, representing the average price people have been willing to pay recently. when the price dips back to it.
Buyers see a chance to get in.
Buyers who miss the initial move or maybe want to add to positions see it as a potentially good entry point. Their buying increases demand right there, hopefully causing that bounce. It's dynamic support moving with the trend.
Okay. So, step by step, if I'm looking for potential support using, say, the 20 MA, what am I doing?
Right. First, confirm. Is price generally above the 20 MA?
Yes.
Okay. Uptrend context looks okay.
Step one.
Step 2, wait for a pullback. Price needs to actually come down and approach or touch that 20 MA. Don't chase it.
Patience. Okay.
Yeah.
Then what? This is the key part, right?
This is crucial. You look for bullish confirmation. You need some sign that buyers are actually stepping in at that MA level.
And what does bullish confirmation look like? Candlesticks.
Candlestick patterns are very common. Things like a hammer, that T-shape showing rejection of lower prices, or a bullish engulfing pattern where a strong green candle completely swallows the previous red one. Big sign of buying pressure.
Anything else? Volume.
Volume's a great one. If you see trading volume pick up as the price hits the MA and starts to bounce, that adds conviction. It means more people are participating in that potential reversal.
Right. So if I see that pullback, touch the MA, get a bullish candle pattern, maybe with higher volume, what's the next thought process for a trade?
Well, you're considering a buy trade. That confirmation gives you a reason to enter near the MA.
Yeah.
But, and this is vital, always manage the risk.
Stop loss.
Always. Place a stop-loss order just below the moving average itself, or perhaps below the low point of that pullback candle, the swing low. That protects you if the support fails.
Can you give us a concrete example? Put it all together.
Sure. Let's say daily chart, a stock's been trending up nicely, price pulls back, comes down, and touches the 50-period MA.
Right.
Right there, you see a bullish pin bar form long lower wick, small body.
Like a bright candle?
Exactly. That suggests the 50 MA is acting as support. Buyers defended it, and that pin bar is your bullish confirmation signal. It increases the probability of the price moving higher from there.
Very clear. Okay, let's flip it. Identifying resistance, what's the starting condition?
The starting point is price trading below the moving average you're focused on. In that context, the MA has the potential to act as a ceiling during those temporary upward bounces or rallies.
And the mechanism. Why would price stall there?
In a downtrend, the MA is sloping downwards. When price rallies back up towards it, sellers often see it as an opportunity.
To sell high, relatively speaking.
Yeah, or to initiate new short positions. Betting on the downtrend continuing, they defend that level, basically. So the MA acts as dynamic resistance, moving down with the trend.
So if I'm watching for resistance, say on the 20 MA again, what's the sequence?
Similar process, just reversed. First, confirm. Price trading below the 20 MA, yes. Okay, downtrend context seems present.
Step 1.
Step 2, wait for a rally. Price needs to move up and approach or touch that 20 MA.
Don't jump the gun. Okay, then.
Then you look for bearish confirmation. You need evidence that sellers are actively pushing back at that level.
And what forms does bearish confirmation take? More candlesticks.
Yep. Bearish candlestick patterns are key. A shooting star, small body, long upper wick showing rejection of higher prices, or a bearish engulfing pattern where a big red candle overwhelms the previous green one. Strong selling signal.
Volume important here too.
It can be. An increase in volume as price hits the MA and gets rejected can indicate strong selling pressure, more conviction behind the move down.
Okay, so I see price rally to the MA, get a bearish candle, maybe higher volume. How does a trader think about acting?
If considering a sell or short trade, that confirmation provides a potential entry point near the MA. And again, risk management is paramount.
Stop loss above the MA.
Exactly. Place a stop-loss order just above the moving average or maybe above the high of that rejection candle, the swing high. Limits your loss if the resistance breaks.
Can we have an example for resistance too?
Sure. Imagine a 4-hour chart, currency pair, clear downtrend, price rallies up, touches the 20-period MA. Right at that point, a big bearish engulfing candle forms.
Okay.
That strongly suggests the 20 MA is holding its resistance, the engulfing pattern is your bearish confirmation, and the odds favor the price turning back down.
Got it. So identifying these levels makes sense, but you keep mentioning trend context. How critical is that?
Oh, it's absolutely crucial. In a clear uptrend, using those shorter MAs, like the 9 or 20, for support during pullbacks often works well. They're closer to the action, give earlier signals.
Than the longer ones.
The longer ones, the 50 or 200, can act as sort of secondary, stronger support zones if you get a much deeper pullback, like major levels of defense for the trend.
Okay. And in a downtrend, how do we use them for resistance?
Same idea, flipped. In a downtrend, look to the shorter MAs, the 9 or 20, as potential resistance points during rallies. Good spots to potentially exit longs or look for short entries.
And the 50 and 200.
They become the more significant resistance hurdles if you get a stronger counter-trend rally. The levels that really need to break for the downtrend to be seriously questioned.
But what about when there's no clear trend? Sideways markets, ranges.
Yeah, that's where you need to be careful. Moving averages are generally less reliable as distinct support or resistance in choppy, range-bound markets. Price tends to just chop back and forth across them.
So maybe don't rely on MA bounces in those conditions.
Generally, no. Not unless you get really strong confirmation from other tools or specific price patterns. In ranges, other indicators, maybe oscillators like RSI or stochastics, or even just identifying the range boundaries might be more helpful.
Okay, that makes sense. So context is king. Let's dive deeper into when to favor each MA. The 9 period again, when is it the go-to?
The 9MA really shines on very short time frames. Think 1 minute, 5 minute, maybe up to 15-minute or hourly charts in very fast markets. It's for capturing quick moves, pullbacks during strong momentum bursts or breakouts.
Day trading scalping territory?
Exactly. That's its sweet spot.
Quick example of it as support there.
5-minute chart, stock rockets up, pulls back briefly just to kiss the 9MA, forms a tiny bullish candle, and takes off again. That kind of quick touch and go.
And resistance.
Same idea, reversed. 15-minute chart, pair is dropping hard, bounces slightly to the 9MA, forms a little bearish pin bar, and rolls over again. Very immediate reaction.
And the big warning is?
Whipsaws. Especially if the market isn't strongly trending. It's so sensitive, it can give misleading signals in choppy conditions. Always needs confirmation.
Right. Okay, the 20 period MA, when does this become more useful?
The 20 MA is kind of the workhorse for short to medium term. 15-minute, hourly, 4-hour charts. It's really effective in established trends for finding pullback entries or seeing where counter-trend moves might stall.
Swing trading favorite?
Very much so. Many swing trading strategies incorporate the 20-period MA.
Example of 20 MA support.
Okay, 1-hour chart. Stock is grinding higher. Pulls back cleanly to the 20 MA. Maybe volume picks up a bit on the bounce. Forms a nice bullish candle. Classic setup.
And resistance.
4-hour chart. Commodity in a downtrend. Rallies up to the 20 MA. Maybe coincides with an overbought reading on an oscillator like RSI. And then forms a bearish engulfing pattern. Suggests a potential short entry.
And the caution for the 20 MA. Less reliable when? Less reliable when the market's just going sideways, stuck in a range. Price might just wiggle around it. Using something like the ADX indicator to confirm trend strength first can be helpful before leaning too heavily on the 20 MA.
Good tip. All right, moving up. The 50-period MA. When does this take center stage?
The 50 MA is really for that medium-term perspective. Think 4-hour, daily charts primarily. It helps identify more significant support and resistance levels within established broader trends. And remember, the institutions watch this one.
That institutional factor adds weight. Example of 50 MA support on a daily.
Daily chart. Stock's been in a solid uptrend for months. Experiences a deeper correction, comes back to the 50 MA, finds bids there, forms a strong bullish engulfing pattern. That's often seen as a sign the medium-term trend is resuming.
And resistance on the daily.
Daily chart. Currency pair and a clear downtrend. Rallies back up to the 50 MA, stalls, forms a shooting star candle. That suggests the 50 MA is capping the rally. Sellers are defending that medium-term level.
What's the main thing to remember with the 50? It's speed. Yeah, it's slower than the 9 or 20. It won't react to every little wiggle. So for fine-tuning entries, some traders like to combine it with a shorter MA. Look for the price to respect the 50, but maybe use the 20 for the actual trigger.
Makes sense. Okay, the heavyweight. The 200 period MA. When is this absolutely critical?
The 200 MA is primarily for the long game. Daily, weekly charts. It's fundamental for identifying major, long-term trend shifts and significant support resistance zones. It's the big picture indicator, bull market or bear market territory.
Give us an example of major long-term support at the 200 MA.
Think about a major index like the S&P 500 on a weekly chart. If it pulls back during a bull market and finds strong support right at the 200-week moving average, it's often seen by long-term investors as a key area to buy, reinforcing the uptrend.
A line in the sand, almost.
Very much so.
And as major long-term resistance.
Daily chart. A stock that's been beaten down in a bear market. It tries to rally, but hits the 200-day MA and gets firmly rejected, maybe on heavy volume. That signals the long-term downtrend is likely still in force, capping recovery attempts.
And the key characteristic is its slow reaction time.
Exactly. It moves very slowly, very deliberately. It's not for timing short-term trades. It's for strategic decisions about the overall market direction. Combine it with shorter MAs for tactical timing if needed.
Okay, we've got a good sense of when to use each. What about some overall practical tips for using any of these MAs effectively as support or resistance?
Number one, I'd say, is always look for that price action confirmation we talked about. Candlestick patterns, hammers, engulfing bars, pin bars right at the MA level, or significant volume spikes. Don't just trade the test.
Wait for the reaction.
Wait for the reaction, exactly. Validate the level.
What about using multiple MAs together?
Very powerful. That idea of confluence. If price pulls back to, say, the 20 MA and the 50 MA is sitting just below it, that creates a stronger potential support zone. Multiple levels agreeing adds weight. Same for resistance.
We keep coming back to time frames.
Because it's critical.
Yeah.
Shorter MAs, 9, 20, are more relevant on lower time frames. Longer MAs, 50, 200, carry more weight on higher time frames, daily, weekly. Use the right tool for the job based on your trading horizon.
Makes sense. And combining with other indicators.
Yeah, definitely helps. Confirm the trend first using something like ADX, or look for supporting signals from oscillators like RSI or Mansi D. Are they showing momentum confirming the bounce or rejection at the MA? It built a better case.
And that warning about choppy markets again.
Worth repeating. MAs are trend-following tools. They struggle in sideways, range-bound markets. Price will often just slice through them. Consider range trading tools like Bollinger Bands or oscillators in those conditions. Don't force MA strategies where they don't fit.
And the absolute must-do.
Stop losses. Always.
Yeah.
Every single trade based on MA support or resistance needs a defined stop loss. Below support for buys, above resistance for sells. Protect your capital. The MA might not hold.
Okay, let's try and visualize this with different trading styles. Say, a day trader on a 5-minute chart. How might they use the 9 and 20 MAs?
Okay, 5-minute chart, strong intraday uptrend. Price pulls back towards the 9 MA, maybe it touches it, forms a little bullish candle. The 20 MA is trailing below as secondary support. The trader might enter long near the 9 MA, looking for confirmation, stop below the recent low or the 9 MA itself.
Quick in, quick out potentially.
Potentially, yeah.
How about a swing trader on a 4-hour chart using the 20 and 50?
4-hour chart, clear downtrend. Price rallies up towards the 20 MA. Maybe the RSI is getting overbought. Price hits the 20 MA, forms a bearish pin bar or engulfing pattern. The 50 MA is higher up, acting as stronger potential resistance. The trader might enter short near that 20 MA rejection, stop above the high or the MA, aiming for the next swing lower.
Holding for a few days, perhaps?
Could be.
And a position trader daily chart using the 50 and 200.
Daily chart, long-term uptrend, confirmed by price being above the 200 MA. Price pulls back significantly, maybe tests the 50-day MA, finds support there, forms a bullish pattern, perhaps Mansi D gives a bullish crossover too. They might add to their long position, seeing it as a dip buying opportunity within the major uptrend defined by the 200 MA. Stop might be below the 50 MA or a key swing low.
Using the MAs to manage a longer-term position.
Exactly. Adding on strength using key levels.
Great examples. Now, what are the common tripwires? Mistakes people make using MAs for support and resistance.
Oh, yeah. False breakouts are a big one. Price pokes just above a resistance MA or just below a support MA, sucks people in, and then snaps right back.
How do you avoid that?
Wait for confirmation. Don't just trade the break. Wait for a candle to close decisively beyond the MA. See if there's follow-through.
Patience again. What else?
Relying only on moving averages. They're lagging indicators, remember. They're based on past prices.
Yeah.
Using them in isolation can lead you astray. Combine them with other tools, ideally some leading indicators or price patterns.
Don't put all your eggs in the MA basket.
Exactly. Another one is ignoring the overall market context, that trend thing again. MAs work best in trends. Using MA bounce strategies in a choppy, directionless market is often a recipe for frustration. Use trend filters like ADX.
Know your market environment.
Know your environment. And the last one, we've said it, but it's critical. Neglecting risk management. Failing to use stop losses or betting too big on an MA level holding. Even the strongest levels can break. Protect your capital.
Absolutely fundamental. Well, this has been incredibly insightful, a real deep dive into using these key moving averages for dynamic support and resistance.
It really has. And I think the core takeaway for you listening is that, yes, the 9, 20, 50, and 200 MAs are incredibly useful for spotting these potential turning points. But
their effectiveness really depends on things like your trading style, the time frame you're watching, and crucially, the current market conditions.
Precisely. Shorter-term traders will naturally gravitate towards the faster 9 and 20 MAs for those quicker signals.
While medium and longer term folks will likely find the 50 and 200 MAs more significant for identifying major levels and the bigger trend to picture.
Yeah, and that overarching theme. Always look for confirmation. Don't just take the MA level at face value.
Look for the price action, the volume, maybe agreement from other indicators.
And be ready to adapt.
Mm-hmm.
What works in a strong trend won't necessarily work when the market goes sideways.
So, a final thought to leave you with as you watch these moving averages on your own charts, think about how they interact. How does the relationship between the short term, medium term, and long term MAs maybe give you clues about market psychology, about potential future moves? It's a fascinating dynamic to observe.
It really is.
Thanks for joining us on this deep dive.